the market isn't having the greatest day, nearly red right across the board. And if we were to take an updated look at the Fear and Greed Index, right now we are sitting in neutral, although we are moving towards fear. Remember, just last week, sentiment was of greed, and one earnings that will shift the market is happening today. The biggest one, in our opinion, Nvidia. They're reporting after the market close in just a few hours, and that can definitely move the market. Definitely one to follow up on, and something we will review when it is released later today. Now, today's focus is going to be on 4 dividend must-buy stocks, particularly for those that love the yield, and we're going to discuss a bit about why we believe these 4 are great. And if you do stick around towards the end, we're going to run through 7 others at a very high level. Now, the first one is PepsiCo. This is a company that has been there for such a long time. In fact, they are a dividend king. They've increased the dividends for more than 50 years. And we can see here, in fact, over the last 12 months, not the greatest period, down 5%. Also, with RFK being announced as the HHS, there has been some pressure on this market, as well as we have covered some of the big pharma. Now, over the last 10 years, they're up around 60%. Not the greatest, although bear in mind, this is if you had bought 10 years ago, and also doesn't include dividends reinvested. We can see all-time highs just below $200 around a year and a half ago. Right now, pretty much trading at its 52-week low. And we do want to point out all 3 analysts, Seeking Alpha, Wall Street and Quant, give this a hold, but bear in mind 3.5 isn't far off where Wall Street sit, and that would turn this into a buy. Now, the yield very high. We're going to show you, in fact, the highest over the last 5 years, nearing 3.5%, and the forward P, the lowest over the last 5 at 19.23. Now, when we take a look at their earnings over the next 4 quarters, they are expecting growth around mid to high single digit quarter on quarter. And what we are impressed by is over the last 4 quarters, management have outperformed. That is a 100% track record on the historical forecasting accuracy, in which over the next full year accounts, if they do hit the EPS, the forward P will be lowered to 18.13. Now, PepsiCo, they have a dividend safety score of 93, making it very safe. And as we will go on to discuss, these are 2 severe undervaluation signals, with a very impressive 7.1% increase to the dividend in February this year, something that they have done on quite a historical and continual basis. Now, we can see it was reaffirmed just a few weeks ago, the very safe score, which in turn means a dividend cut for PepsiCo is highly unlikely. Then we're going to move into the key metrics, essentially from the Great Recession 07-09. They increased the dividend. They had pretty much flat recession sales, which was well above the average of the S&P, clocking in at -12, and they also massively outperformed in terms of return, -35, the S&P itself, -55. As we can see, very consistent in the increases, in fact 7% year on year over the last 5, and double digits coming in at 11% over the last 20 years. And as we mentioned at the beginning of the episode, they are a dividend king. They've increased the dividend 51 years in a row, but they've also been paying a dividend for the last 59 without a reduction. Then we're going to take a look at this valuation model, which is based on the forward P. But just bear in mind, before we conclude on this, we're not looking at any of these models in isolation, and we'll run it through our own valuation process shortly as well. What this shows us is the blue tunnel expected fair value of PepsiCo. In fact, for the majority of the last year, it has been well below that. Right now, we saw a largening of that gap, indicating severe undervaluation. And that is also essentially backed up in dividend yield theory, which tells us here a company is undervalued when the current yield is above the 5-year, 3.44 above the 2.84 of the 5-year rolling, and as we can see, pretty much the highest yield it has offered over the last 5, unless you did buy it on that one day during COVID where the whole market did drop significantly. In terms of the forward P, the same to be applied, 18.5, well below the 5-year average of 24. These are some severe undervaluation signals, and we are seeing it now. It was in fact a lot higher. Now it has come down to around the average of the whole sector of consumer staples at 18.2. Then when we look at the free cash flow payout, remember on this channel we do draw your attention to the free cash flow over the earnings, which is susceptible to manipulation by management through accounting. Below 70 for the industry of consumer staples. This is the one issue we have with this company. It is very, very high. In fact, triple digits in 2022. Firstly, you wouldn't be able to tell that from the earnings payout. That is why we look at this one. Tells us management paid out more in dividends than they generated in free cash flow. The good thing is it did decrease in 2023 and expected to come down to the upper ends of what we want to see at 70% over the next 12. Just something that we do want to draw to your attention. We then move to the free cash flow per share, where we want to see consistent increases over long term. We note inconsistency here, so do bear that in mind. Yes, it has increased though from 2014 to 2023, and over the next 12 months, we are anticipating quite a large jump to $7.76 per share. In terms of sales growth, minimum we want to see is 3 to 4% just to keep up in line with inflation, but ideally 3 to 7 for that steady, moderate growth. And we can see over the last few years, in the more recent period, their top line has looked very good, and from a numerical basis, they've increased around 40% from 2014 to 2023. In terms of shares outstanding, we want to see companies that return excess cash through share buybacks. Now, PepsiCo have done that, but very inconsistent. And in fact, from 2020, we're talking around 4 to 5 years, they haven't really focused this. It hasn't been a priority of management in their capital allocation, and they seem to focus on more paying out a nice, attractive dividend increase, as we saw 7% this year. Now, ROIC, our favorite metric, 10% or more, 12 for the industry. Give us faith. Management are able to effectively allocate their capital, very consistent and above essentially the 12% minimum, so we like to see this. 20% on a trailing 12 month, also very attractive for shareholders and those who are looking to buy. We then want to see operating margin above 16% and efficiency where it's increasing over time. What we just get straddling around the 16% level, which is a bit of a shame, but pretty much something reflected right across the market. 15% on a trailing 12 month. And the same to be said for the free cash flow. We want around 7% as a minimum, and whilst it has been decreasing over the last 10 years, nonetheless, over the last few years, still around that 7%. So again, nothing amazing, but also no red flag indicators. And then we get to the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Below 4 is what we want to see for the industry, and the numbers you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. Why we focus on this metric correlates to both dividend safety, balance sheet strength. Good to see from the highs of 2020 at 2.66, it has started to come down. 1.95 on the trailing 12 month, 1.83 over the next 12 months. So a good sign that management are focusing on this. Yes, they may not be doing share buybacks, but what instead they're doing is paying off debt, delivering the balance sheet, and also increasing the dividend at a very attractive rate. Now let's jump into the valuation model. As always, value is provided. You are enjoying the content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now typically on this channel we do run through every single one of these models. We talk about the inputs and the outputs. Today we're going to jump straight into it. We get $172, and with the current price we always like to do a margin of safety. Now we start at 10%, we execute on this if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. So what we're saying for PepsiCo is that a 10% MOS around the $155 mark, where it isn't too far off, you're getting 10% whilst Wall Street believe you have 18% upside over the next year at $185. Now bear in mind, dividend lovers will like to see that yield around 3.5%. You may not get massive amount of growth with this company, but what you will get is that stable increase to the dividend as well as a fairly attractive forward yield. As always though, give us your thoughts. Some people will believe that with the new president coming in, with the team that he is assembling, RFK, they will hurt companies like PepsiCo, like Big Pharma, and others will believe that the market is overreacting. This is a great opportunity to consider a dividend king with a very strong starting yield and a very low forward P in relation to the 5-year averages. As always though, give us your thoughts as we go along these companies today. We also want to let you know we have released our latest free weekly article. We deliver one every single Monday morning to your inbox, where we cover severely undervalued stocks that we believe deserve your attention, as well as what's gone in the market over the last few days. So click below, sign up, and you can start reading straight away, as well as grabbing a copy of 40 undervalued stocks for the month of November. Lots of information, upside that Wall Street themselves see over the next year. And on top of that, you can grab another spreadsheet with 22 undervalued dividend stocks that Wall Street themselves believe right now have the most upside in the S&P 500. So click below, sign up, and you can start reading straight away. We then move on to Nike, which is actually one Bill Ackman bought more of in his portfolio, as we did analyze not too long ago. It is trading right there at its 52-week low, down 32% over the last 12 months. Over the last 10 years, up only 47%. As we can see, hasn't come, in fact, anywhere near its all-time highs of around $180 pretty much 3 years ago. We notice just one buy rating, that is from Wall Street, a double hold from Seeking Alpha and Quant, and a very attractive starting yield for this company, as we will show you the highest out of the last 5 years at around 2.2%, with a forward PE at 26.33. In terms of their earnings, well, they do anticipate out of the next 4, only one of them to be positive. The next 3 actually double-digit EPS decrease year on year. But we also like the fact over the last 4 quarters, they have outperformed analyst targets, 100% track record. So if they do hit their next full year EPS 3.23, the forward PE will come down to around 22.9. We get another very safe dividend score. We do want to clarify though, 99 the highest score obtainable, so that does look very good, and a double severe undervaluation signal like we saw with PepsiCo. A nice 8.1% increase to the dividend this month as well. Love to see that from this company, especially given they have had some hard times. And it was reaffirmed last month, again, very safe, so the similar conclusion that we saw for Pep. In terms of key metrics, well, they increased the dividend during the last recession, -7%, still above the average, remember -12, and also massively outperformed the S&P, -36, versus the S&P's -55. Great increase this month, great increase over the last 5 years, and very attractive 15% increase year on year over the last 20. And they've been increasing those dividends for the last 22 years on a consecutive basis. Remember, 3 more years of this, they will gain dividend aristocrat status, and they've been paying a dividend for the last 40 years without a reduction. In terms of the valuation model based on the forward PE, over the last 12 months, in fact, for the vast majority, they have been severely undervalued, and that same conclusion still applies at today's date. Then we look at dividend yield, where we get to see massive undervaluation, 2.2, well above the 1.08, and even higher significantly than when it dropped in COVID, as we can see here. And the same to be said on the forward PE, 25.3, which still does look very pricey, but we can see over the last 5 years, the average has been 31.9, but ultimately it still trades significantly higher than the consumer discretionary at 14.8. Is it worth a premium? That is something to consider. In terms of the free cash flow payout, below 60%, 33 in 2024. Now over the next 12 months, it is expected to climb very high. Definitely something we would say to keep our eye on, and something we will also take a look at on a quarter by quarter basis. Then we get to the free cash flow per share, which doesn't look a little bit more consistent that we saw with PepsiCo. In fact, doubled from 2015 to 2024, but we do need to make you aware over the next 12 months, this is expected to drop to 170, and we did see on the EPS expectations over the next 3 years, that is anticipated to come down. In terms of sales growth, for the majority of the period, it has looked decent, although we do notice the more recent year, it has been flat, and over the last 12 months, -3%, indicating we may see another flat year in 2025. In terms of numericals, around 60 to 70% increase over the last 10 years, and again, very similar conclusion to PepsiCo. Yes, they have been doing share buybacks, but fairly inconsistent and not every single year. ROIC, no complaints whatsoever, 25% in 2024, 22 on a trailing 12 month, and looks historically very, very good. We do like the numbers that they have been pulling out for this metric. And then we get to the operating side. Again, very similar, no operating efficiency, but it does straddle around the minimum levels that we want on a year-on-year basis. Free cash flow, no complaints whatsoever, nice 15% on a trailing 12 month. Balance sheet looking very, very good. Below 3 is what we want to see. 0.05 in 2024. Yes, a marginal increase anticipated over the next 12 months, but no surprises as to why we got that 99 very safe dividend score. Now our intrinsic value, and do remember you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for NKE or in fact any others. We got to 98, and as we do run it through the MOS at 10%, a buy at 88, at 20% around 78. I'm not quite at the 30% level just yet, so today's episode right now, with the drop it continues to have on a week by week basis, 25% MOS, 27% upside, $93 price target. Do give us your thoughts whether or not this is one you have been accumulating over the last few months. We then move on to Merck Co, one that we have continued to talk about on this channel, trading right there towards its 52-week lows with a double buy and a hold from quant. The forward yield over 3% at 3.2, forward P at 12.5, and over the last year it is down around 5%, over the last 10 years up around 61. When we take a look though, they are expecting some very large growth on a year-on-year basis for the next 4 quarters and a 100% track record. These are things that we really like to note, and earnings per share is continued to grow, lowering the forward PE to 10.2. In terms of dividend safety, well look, another very safe, that's 3 in a row. Severe undervaluation also noted, and I believe today we just got a dividend increase coming in at 5.2%. In terms of the last recession, they maintained the dividend. They had a negative 4%, so above average growth, and pretty much an S&P return at negative 57%. They've also increased the dividend very attractively over the last 5 years at 9% on average, and over the last 20, at a bare minimum, it has been in line with inflation at 4%, meaning that we can see 12 years of consecutive increases, although they have been paying a dividend for the last 53 years without a reduction. Then we get to this valuation model where, as we can see, it isn't out of the blue tunnel, but right there towards it, which does give us that undervaluation signal. However, when we get to dividend yield theory as well as the forward PE, that is reinforced. 3.34 above the 2.97, 10.8 below the 5-year average. So undervaluation signals all throughout, including the fact that the healthcare sector does trade much higher at 15.8, meaning Merck Co today is trading at a discount to the sector median. Free cash flow payout, well, what we do notice, some years that have been questionable at the triple-digit rate, not the greatest in 2023, but nice to note over the next 12 months, this is anticipated to come down to 39%. We also see free cash flow increasing over the longer term, not consistently, which as always is a little bit of a concern, but nice to see over the next 12 months, it is pretty much anticipated to more than double to $8.24 per share. Sales growth, we also get some inconsistency in the numbers, and 2023 not looking great at 1%. Good to see, however, on a trailing 12-month, 7%, indicating 2024's full year accounts should be significantly better. We also notice around 50% growth from 2014's $42 billion to $60 in 2023, and pretty much mirroring the previous 2 companies, shares have been bought back but very inconsistently, and maybe not something management are prioritizing. ROIC, no worries whatsoever, and in fact increasing over longer term, 23% looking good on the trailing 12 month, and we actually get our first sign of operating efficiency well above the minimum 12%, 22 in 2014, 30% on a trailing 12 month, and the free cash flow, whilst inconsistent on a year-on-year basis, very nice to see, and there's that 24% on the trailing 12 month. Then we get to the net debt to EBITDA. Now 2.81 would probably put you off in 2023, but on a trailing 12 month, it has come down significantly to 1.13, and over the next 12 months, expected to come down to 0.76, so no surprise again why we have this third in a row very safe dividend score. Now our intrinsic value at $132, pretty much in line with where Wall Street see this over the next year, $133 price target indicating 38% upside, and when we look in terms of margin of safety, we can see that for this company, not at the 30% level just yet, but you are getting up to around $100, 25% MOS, and as we said, 38% upside. As always, give us your thoughts below. We then move on to the Hershey Company, where actually last time we reviewed this, it was sitting around $180, and we had 3 holds across the board. Right now, we see Seeking Alpha has flipped into a buy, Wall Street and Quant, however, sticking with their previous ratings. As we can see, pretty much at its 52-week low, a very attractive forward yield at 3.22%, a forward P at just below 19. Over the last year, not great, down 11%. Over the last 10 years, up 72%, and given the rise in cocoa prices, the share price has come down from the highs in May 2023 at $275. Now over the next 4 quarters, they are expecting 2 of them to be positive, but we do have to mention out of the last 4, and in fact it has been the more recent 2, they did miss their targets by quite a fairly substantial amount. The other thing that we do need to point out is the earnings per share is anticipated to drop, and therefore the forward P to rise to around 20.6. In terms of dividend safety, whilst not very safe, making it a 4 of 4, it is still safe at 80 nonetheless, with another double severe undervaluation signal and an incredibly attractive 15% increase in February this year. Now, for those that want to know the difference, it was reaffirmed in August, essentially the safe score, and the safe rating suggests a dividend cut is unlikely as opposed to the very safe where it says highly unlikely. Then in terms of the key metrics, they maintained the dividend, so they didn't increase it during the last recession, they also didn't cut it, they pretty much had flat sales, which was above the average growth, and they had a recession return negative 30%, so beating the S&P's negative 55. Yes, very attractive, not only in 2024, but also over both the last 5 and the last 20 years, with increasing that dividend at a 10% annual rate. And in terms of growth, 14 years of consecutive increases whilst paying a dividend for the last 94 without a reduction. Then we get to the valuation, where we look at it in terms of the forward P, and for the majority of the last year, we can see and continue today this company well below even the lower end of the intrinsic value. And we get that reinforced in terms of dividend yield theory, very high in comparison to the 5-year average, and the forward P at 20.6, lower than the 5-year rolling of 23.9, and it's only marginally higher than consumer staples at 18.2. In terms of the free cash flow payout, no real worries, below 70% is pretty much what we get every year, 61 anticipated over the next 12 months. And in terms of free cash flow, maybe the most consistent we have seen today, and expected to go up again over the next 12 months to just under $9 of free cash flow per share. Now, whilst their top line hasn't been the greatest over the last 10 years, the last 3 have been fairly decent, above the minimum 7% in 2021 and 2022. However, over the last 12 months, a negative 2%, indicating that 2024 might be a bit of a struggle for Hershey Company. In terms of their sales, well, pretty much around 50% growth over the last 10 years. And what we actually notice here in terms of shares outstanding, 4 for 4 today, where we have companies that do share buybacks, but not very consistent in terms of the amount they do on a year-on-year basis. ROIC, absolutely no worries. Above 12% is exactly what we get on a continued basis. On average, over the last 6 years, around 25%. Very good to note. And we also get marginal operating efficiencies, 20% in 2014, 23% in 2023 and the trailing 12 month. And we also like the free cash flow has been increasing and pretty much above the minimum every single year. Finally, we get to the net debt to EBITDA. Below 4 is what we want. That is what we get. 1.49 in 2023, 1.78, so a marginal increase over the next year anticipated, but still well below the minimum. Definitely a decent balance sheet. Now, in terms of running into their valuation, well, intrinsic value at $203, we can see Wall Street there or thereabouts with 17% upside. In terms of our MOS, well, at 10%, a buy at 183, at 15%, around 173, which is where we see it now, 15% MOS, 17% upside. For those that want to see at 20%, around 162, at 25, around 152. So we ran through 4 undervalued dividend stocks, all having very attractive starting yields and in fact significantly higher than their 5-year averages. There are other companies that we do believe are worthy of a notable mention. The only reason we haven't gone into detail with these essential 7 is because we have covered them lately, otherwise they would likely apply to the same criteria. You have Canadian National Railway Company, this one essentially trading at its 52-week lows, a forward yield of 2.25%, and we just get one buy from Seeking Alpha, but as we mentioned, 3.5 to turn it into a buy, so Wall Street aren't far off themselves. Definitely one that we would say for some serious consideration. We then have ASML, where we can see again trading at its 52-week low. We have just one buy rating from Wall Street, not far off the Seeking Alpha, with a yield of around 1.01%. Again, as we would say, one to consider, especially if you want some exposure to the semiconductor space. We then have Pfizer, which took an additional hit after the RFK appointment. We can see right now trading right towards its 52-week lows. We have a double buy from Seeking Alpha from Wall Street. We have a forward yield, the highest today at 6.7%, and a forward P at around 8.6. We then have Elevance Health. Again, trading at its 52-week lows, the market has taken a bit of a battering lately for some of these dividend stock companies. Double buy rating, but interesting to note, Wall Street, in fact, 4.5 would be a strong buy, so definitely one they seriously believe to consider. In terms of forward yield, 1.65%, forward P just below 12. Then we move into Mondelez, very similar to Hershey Company. We get our first strong buy, that is from Wall Street, a forward yield just shy of 3%, forward P around 18.3, and as we can see, right there at its 52-week low. We then have Lam Research. If you want more information, we literally covered this one yesterday. We get a double buy rating, seeking alpha Wall Street, hold from quant. Forward yield 1.31%, in terms of a forward P just below 20, and pretty much as we can see, just $1 shy from the 52-week low. And then we end with Novo Nordisk. Now this one is a little bit away from its actual 52-week low, but it is moving towards there. Wall Street giving it a buy with the other two a hold. And we can see forward P around 32 and a forward yield of 1.41. So these were essentially 7 additional companies that we do believe meet that criteria that we have just gone through for the last 4. And if you want any of these in an in-depth dive, we have covered them very likely within the last few weeks, but do let us know if you want us to revisit any of them. As always, if you enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.